When it comes to growing your wealth, the order in which you invest your money is just as important as the amount you invest. Many people make the mistake of jumping straight into the stock market or real estate without first securing the basics of their financial life. This often leads to stress, poor decisions, and even losses. The smartest approach is to build a strong financial foundation, take advantage of available benefits, and then gradually move into higher growth investments. So let's look at what a smart investment order actually looks like, how it works, and why it makes wealth easier to build over time. The first step in any smart investing plan is to establish a strong financial foundation. This means taking care of basic financial needs before attempting to grow your money. One of the most important parts of a foundation is an emergency fund. An emergency fund is money set aside to cover unexpected expenses, such as medical bills, car repairs, or sudden job loss. Without this safety net, you may be forced to sell investments at a loss or borrow money at high interest when an unexpected expense arises. A practical goal is to save 3 to 6 months' worth of living expenses in an account that is safe and accessible, like a savings account. This money should be separate from your regular spending money. Having an emergency fund gives peace of mind, reduces stress, and allows you to make investment decisions without worrying about immediate financial problems. Alongside an emergency fund, it is crucial to pay off high-interest debt before you start investing. High-interest debt, such as credit cards, payday loans, or personal loans, can grow quickly and become a major obstacle to building wealth. For example, if a credit card charges 20% interest per year, it would be difficult for most investments to outperform that guaranteed cost. By paying off high-interest debt first, you effectively earn a risk-free return equal to the interest rate you eliminate. This step strengthens your financial foundation and allows you to start investing with more confidence and less stress. Understanding your budget and cash flow is essential for investing wisely. Know exactly how much money you earn, how much you spend, and how much you can consistently set aside for investments. Track your expenses carefully and identify areas where you can reduce unnecessary spending. Even small, consistent contributions to investments can grow significantly over time because of compounding. Consistency is more important than size in the early stages of investing. A clear budget also prevents you from overextending yourself financially and ensures that your investment strategy is realistic and sustainable. After building a foundation, it makes sense to take advantage of employer benefits. Many employers offer programs that can accelerate your wealth-building journey but are often overlooked. Employer-sponsored retirement plans, such as a 401k, allow you to save for the long term while reducing taxable income. One of the biggest advantages of these plans is the employer match. Many companies will match a portion of your contributions, which is essentially free money. Failing to contribute enough to earn the full match is like leaving money on the table. Even if you can only afford a small contribution initially, starting and gradually increasing it over time sets you on a strong path. Employers may also offer stock purchase plans, health savings accounts, or educational reimbursement programs. Stock purchase plans let you buy company stock at a discount, potentially giving your money higher returns if the company performs well. Health savings accounts, HSAs, allow you to save for medical expenses with pre-tax dollars and often grow tax-free, making them a useful long-term investment tool. Educational reimbursement programs can increase your income potential by covering the cost of courses or certifications. Taking full advantage of these benefits is a simple way to grow your money without taking on extra risk. Low-risk investments provide stability and liquidity while you continue building your financial base. High-yield savings accounts, certificates of deposit, and money market accounts are good options. These investments may not provide the high returns of stocks or real estate, but they are safe and accessible. They help you practice discipline and develop good habits, such as contributing regularly and resisting impulsive spending. Low-risk investments act as a bridge between saving and higher growth investing, giving your money the opportunity to start working for you safely. It is also wise to reduce moderate interest debt, such as car loans, personal loans, or student loans. This type of debt is not as urgent as high-interest debt, but lowering it before investing in higher-risk assets adds stability to your financial situation. Paying off debt increases your cash flow and reduces monthly obligations, giving you more flexibility to invest consistently. Eliminating unnecessary debt protects your future investments from being affected by financial strain and sets you up for steady growth over time. When your foundation is secure, employer benefits are maximized, and debt is manageable, it is time to focus on growth investments. A good starting point is broad-based index funds or exchange-traded funds, ETFs. These funds track a market index, such as the S&P 500, and provide exposure to many companies at once. Index funds are safer than picking individual stocks because they spread risk across multiple businesses and sectors. Over the long term, index funds have provided steady growth, making them an excellent choice for first-time investors. Regular contributions, even if small, benefit from compounding and can significantly increase wealth over decades. Once comfortable with index funds, you can explore individual stocks. Investing in individual companies carries more risk but also offers higher potential returns. Research is critical. Look for companies with strong financials, consistent earnings, competitive advantages, and a clear long-term strategy. Avoid speculative investments based on trends, hype, or short-term price movements. A practical approach is to allocate a small portion of your portfolio to carefully selected stocks while keeping most of your money in diversified funds. This balances growth potential with risk management. Diversification helps protect your investments from market fluctuations. It means spreading your money across different asset classes, industries, and regions. The goal is to avoid being dependent on the success of a single investment or sector. Combining stocks, bonds, real estate, and other assets ensures that your portfolio can withstand market changes while still growing. Diversification allows you to take advantage of growth opportunities in multiple areas while maintaining stability. A well-diversified portfolio is key to long-term financial security and consistent wealth building. Tax-advantaged accounts such as Roth IRAs or traditional IRAs help your money grow more efficiently. Contributions may reduce taxable income or grow tax-free depending on the account type. Consistently investing in these accounts allows compounding to work over time without being diminished by taxes. Avoid withdrawing funds unless necessary, as early withdrawals can reduce both capital and potential returns. Using tax-advantaged accounts strategically accelerates wealth building and ensures your investments grow as effectively as possible. Real estate can complement stocks and bonds, providing income and long-term appreciation. Start with manageable investments, such as a rental property or a real estate investment trust, REIT, to gain experience without taking on excessive risk. Consider factors like location, demand, property condition, financing, and potential cash flow. Real estate offers diversification and can generate passive income, making it a valuable part of a balanced investment strategy. Approach it with research, patience, and a clear plan. Alternative investments, such as small businesses, peer-to-peer lending, or commodities, may be considered after building a core portfolio. These investments carry higher risk but can provide substantial returns if approached carefully. Allocate only a small portion of your portfolio and understand the risks involved. Alternatives should complement, not replace, core investments in stocks, bonds, and real estate. Education, research, and planning are essential for success in these areas. Regularly reviewing your portfolio ensures your investments stay aligned with your goals and risk tolerance. Financial goals, market conditions, and personal circumstances change over time. Reviewing your portfolio allows you to rebalance your investments, sell assets that have grown too large, or add to areas that are underrepresented. This keeps your portfolio balanced and reduces unnecessary risk while continuing to grow your wealth steadily. Monitoring your portfolio consistently ensures your strategy remains effective over the long term. Patience and discipline are essential for successful investing. Building wealth is a gradual process that requires consistent contributions, careful planning, and the ability to stay calm during market fluctuations. Avoid chasing trends or reacting emotionally to short-term losses. Smart investors focus on long-term growth, trusting the power of compounding and diversification. Following a structured investment order, building a foundation, maximizing benefits, managing debt, starting with low-risk investments and gradually moving into growth opportunities, creates a clear path to financial security